I'm Tim Kelly and welcome to this week's Video Insight. Today I want to talk a bit about business quality, what it is, why we focus on it, and what it means for long-term investment returns. Let's start with what we mean by quality. Different investors have different definitions for business quality, but the underlying ideas tend to be pretty similar. Our specific definition of quality is focused on the ability of a business to invest capital and earn returns above the cost of that capital. We like businesses that have the ability to do this consistently over a long period of time, and the higher the returns and the greater the ability to invest, the better. The reason that this is attractive to us is that a business that can invest at rates above the cost of capital has the ability to create value for shareholders. Every extra dollar that's invested in expanding the business generates an earning stream worth more than $1. In contrast, a business that invests capital and earns a return below the cost of that capital actually destroys value for shareholders. When you think about what that means for the long-term success of the business, the attraction of quality is easy to see. A business that creates shareholder value is going to follow a very different path to a business that destroys shareholder value. Of course, the fact that a business is high quality doesn't mean that its share price rises every year. The accumulation of shareholder value through reinvestment compounds over a long time frame, and in the meantime there will inevitably be ups and downs in the business, and market valuations can move around quite a bit. Sometimes the market is willing to pay a large premium for high quality companies, sometimes it's only willing to pay a small premium. Over the past year, we've seen that the premium that the market is willing to pay for high quality businesses has declined considerably, with lower quality businesses performing far better than high quality businesses. This is certainly not the first time this has happened. Many investors will remember the internet bubble around 2000, for example, when the price of quality became relatively very low. And this won't be the last time it happens. For investors who favour high quality businesses, these periods of relative underperformance are painful. But it's important to remember two things. Firstly, if you're going to adopt a distinctive investment style that works well in the long run, then inevitably there will be short-term periods when that style is out of favour and trailing the market. Secondly, when that happens, it means that the type of businesses you favour have become relatively cheap. And being relatively cheap means that the prospects for future returns to that strategy have improved. So, if you've chosen a sound long-term investment strategy to begin with, the right response in times like these is simply patience. In fact, patience, while it's easier said than done, is almost always a good personality trait for investors to cultivate. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. We'll be expanding on some of these thoughts in our blog this week, including an analysis of the returns of the recently launched Montgomery Alpha Plus Fund. So if you'd like some more insight into the virtues of quality, keep an eye out for that on the rogermontgomery.com website. That's it for this week's Video Insight, but we'll be back with more of these next week. And of course, in the meantime, you can follow our thoughts on Facebook and Twitter.